Hi, Geoff here from GCT Property. Today is a quick video on might help you decide on a strategy as a long-term investor or short-term property investor. So they're both very different strategies that both have their pros and cons. So as a short-term property investor, you really need to be experienced, and that might range from a simple property renovation to property development, subdivisions, etc. So with the short-term strategy, you're really susceptible to things like the property clocks, so when you're buying the property cycle, local market conditions can really have an effect on that, as opposed to a long-term investor where you can afford to ride out those market fluctuations and property clock if you're bought right at the top of the cycle. So for that reason, long-term investors are generally considered a much safer option, where most investors would choose that strategy. And for the long-term strategy, as long as the property's in the market where it's growing, increased rents can help cash flow, which allows you to hold on to the property till the market recovers, essentially to either sell or take the equity growth in the property. So when you're looking at long-term growth, they consider the property cycle in Australia historically has ranged from about 7 to 12 years. So what that means is from the top of the cycle when the properties are most expensive to when they drop off in value, it's about a 7 to 12 year cycle. However, the one thing to take into consideration in today's economic climate is we are in a very low inflation environment, and that means it may take longer to see that growth on the property, as opposed to short-term investors where you're looking to manufacture growth. It's much more critical that you have experience and you know exactly what part of the cycle is happening and what's going on in the area. So if you're looking for a short-term property growth, you really need to be doing feasibility studies. And these are quite a detailed approach where you can calculate, your purchase costs, your holding costs, your development costs, and your percentage of profit that you want to make, and it can calculate, all those sort of factors. And it's a very important factor to get those numbers right when you're doing, short-term property investment, because you can be susceptible to like the Australian economy, the worldwide economy, and there's factors that we wouldn't even be aware of that can have an effect, such as in the past we've seen GFCs, share market crashes where properties could fall quite dramatically over the shorter term. That's what you've got to be very aware of when you're a short-term investor looking to manufacture growth. So you also need to consider with development costs what's called the cost to redevelop the property. So quite often when you're borrowing the cost for the development, you won't be able to borrow all the costs. So if you're doing a renovation project, for example, the banks may lend you the money to buy the property, but you may not be able to borrow the cost to renovate the property and hold on to it, or selling costs, etc. So you need to take those into account. Much like multi-unit developments, there's a lot of costs that need to be come up out of your own pocket that the banks won't lend on. So all those factors need to be considered when you're looking at which strategy has helped you best. So I hope that has given you a bit of an insight and might point you in the right direction. Please contact me on the link below, and I'm happy to send you a link to obtain a feasibility study that you really need to do for short-term property investment. Thanks for watching.